Thank you very much, Anthony. Mark's journey took me back to my time in politics, actually, when the nation introduced the GST and Costello's office was full of stories about mum and dad moving, mum and dad having 3 kids, mum and dad what the GST they would pay on their different prices, on their different purchases. So Mark, I'm sure that Mr Costello would be very proud of your story and journey about stocks and property. What I suppose we failed to really address though was the fact that although property prices may have dropped on paper, if mum and dad from New Zealand don't have to move, they will not lose that money. They can hold on. In shares, we don't have that sort of flexibility, particularly when I was reading on the internet this morning, just before we came over, about a couple that had invested heavily in some heart medication, and they now proudly held shares at 1 cent per share in value. And I'm sure we could find many, many examples of shares that have failed to come anywhere near the 10% year-on-year growth we've seen in property. So what we need to remember is that property is all about the entire market. And looking at recent data over the last 10 years, and we go back even 25 years, 10-year data shows suburbs right across South Australia, into the towns, into the regional areas, have all performed extremely well. Of course, we do see the top 10 suburbs, but when you actually break down to even the lower 10 suburbs, we don't see a big differentiation between the top performance and the lower performance. And I think that's a really important thing for people to know, is that property is stable. Like Greg said, we live in property. Property is always going to be in demand because shelter is a basic human need. We've had extensive studies about population growth, and this will drive demand for housing over many, many years. You simply can't get away from the basic human needs. People say mining, that's the place to be, resources, perhaps we might get a few tips here. But Google bottom 100 companies performing on the ASX, and the top 7 out of 10 are resource stocks. These are things that we're thinking are safe, guys, but these are coming up on the low performers. Property, year on year, that 10% growth. Now, I suppose it depends if you're into the roller coaster ride in real life or you're happy to go to the theme park. If you want to go on the roller coaster of life, go in shares. Mark's happy to take you on that journey. If you want the stability and to go in for Disneyland for a day and come out the other end knowing you've left all the bad memories there, you need to come with property. Now, because the Real Estate Institute is very consumer minded, and we've spent a lot of time with our friends at the Consumer and Business Services Centre, which is the old OCBA recently, our thoughts are very much in consumer protection. And when I think about the complexity of shares, when I think about all of those things that can go wrong, we can't get a building inspection on shares. We can't get a sustainability report because we're starting to think about all those things. Those measures don't exist. You can't do your own research on a major investment, which property offers. It's out of your hands. If you want to take control of your own destiny, if you want to drive past that house and see that it's yours, property's for you. It's the only answer.
Well done, Emma. And right on time as well. Now to wrap up on the other side, on the share side, John Bowers, your time starts now, John.
Thanks, Anthony. Now, I will address some of your barbs in my speech, but I mean, we've spent a lot of time talking about the cons of property, and I think, let's face it, so have you. When you invest in Australian shares, you are buying a slice of an Australian business. BHP, CommBank, Telstra, you name it. And here's the thing, the companies do the hard yards for you. Even though the market has its swings and roundabouts, they get on with the business of making money. As an investor, all you do is sit back and reap the rewards. No unexpected bills, no tenants, no hassle. Another key point we want to leave you with today is liquidity. You simply sell sufficient shareholdings to release your capital, the money is in your pocket within days, not months, and the rest of your investment continues to work. But how easy is that? Shares aren't just hassle-free, they also deliver powerful long-term gains. Let's say, for instance, that you purchased an investment property in early 1993. With upfront cash of $31,000, you're able to buy a residence worth $200,000. Taking into account rental income and capital growth, less the cost of owning your property, by the end of 2009, your slice of Australia is worth $570,000. It's impressive. So how do shares compare? If you'd invested that same $31,000 into the share market at the start of 93, by December 2009, after making regular contributions equal to the cost of the property, and by reinvesting dividends, your investment would be worth $654,000. That's an extra $84,000 in personal wealth and considerably less grey hair. Isn't that right, Mark? So if you're more the buy now, sit back, watch my money grow kind of investor, then you are buying yourself a world of pain with property, ladies and gentlemen. For you, my advice is think shares. I agree with the opposition that Australians love bricks and mortar. Most of us aspire to own our own home. Many back up the family castle with an investment property. Indeed, as every property owner knows, the castle is actually the master, not the servant. Think about your own home. You pay the mortgage for years, with plenty of interest being taken by your bank and little impact on the principal debt. Then you need to maintain it, insure it. Just think about all those bills that just stack up. Just look at them. Let's assume you've committed yourself to the family home and you've got a mortgage. You've managed to generate some surplus cash and income. The question is, shares or investment property? Like your family home, an investment property doesn't just involve an upfront purchase cost. It demands ongoing spending. At the end of the day, are you sure those costs are fully reflected in the value of the property? I'm not. In fact, the best way to maintain and improve the value of your property is by spending more money on it. Funny that, investments are meant to generate value in cash. If you ask me, it all sounds like too much hard work. Being a landlord isn't easy, investing in property isn't easy. I'll leave you with one final thought. Imagine how inflated the share market would be if the government had given first investors a grant instead of homeowners. Everyone would be rich instead of just some baby boomers who are sitting on properties with overinflated prices. Thank you.
Well, we got the media people here. We might see some articles on that one. Well done, John. That's great. And now to finish off for property, welcome back, Greg. And Greg, you've got 1 minute, so get right amongst it.
I'll keep it short, sharp and shiny. Look, I'll throw a bone to the other side here. Unpaid bills, yes, all the rest of it. But yeah, the Russell report, yeah, significant. Shares are pretty good. I'll throw that bone to you, but property's much better. The facts say it. 2, you talk about financial independence. I did hear the other day that during the average retirement, you can expect the share market to crash at least 3 times. Don't ask me where I got the quote from, but that's what I was told. I believe everything I'm told. Finally, go home tonight, walk in, grab yourself a cup of tea, grab the bricks and mortar, give it a bit of a hug. Don't worry about the wife and kids. Give it a bit of a hug because it's going to suit you for the long term.
Well done. Okay. Well, guys, that now wraps up our debate. And so we're over to the public to put your votes and make them count. The lines are open, so make sure on the page, on the web page there, just click the property or shares button. That'll come straight through to us and we'll give you the tally at the end of the show. Now also we have emails and questions. There's a number of them up there. And here we go. So from Marcus, a mate has served several investment properties, each property worth around $450,000, where he makes a net yield of around 3%. On the other hand, I've noted some quality ASX listed companies with a gross yield of 6%, assuming there's no capital growth the next 5 years or so above the shares of property. Then do you agree that it would be better off buying ASX shares because the yields are much higher? Shares first.
Yes.
Take this one. Well, in regards to share investment at the moment in particular, I think that there's some really attractive opportunities around. The market is actually trading at about sort of 15-20% below long-term averages, and you know, Australia is well placed in the world economy at the present stage. You're getting 5% yields with a lot of franking, so you gross that up to sort of close to 7. You know, the stocks are inexpensive at the moment. It's a good long-term way to go at the present stage for sure.
Okay, property?
Love to answer the question. It's all about risk and reward. If you want to feel risky, you might get the reward, but you know, there's a fair few things going on around the world at the moment. And look, I don't want to give you financial advice, but hold off, love your bricks and mortar, sit back with a roof over your head and enjoy your cup of tea.
All right, okay. Now, Megan, Megan has written in my opinion, anyone can buy a property as an investment regardless of their knowledge, intellect, and still, by the way, it refreshes every few seconds, so I've got to read in between. ASEC, where are we? Here we go. And still make a profit. Whereas with shares, you have to know about growth, values, yields, benefit from owning shares. Therefore, isn't probably the best investment as you are guaranteed to make a profit no matter how much knowledge you have. Would you like to start the property side?
I love the idea. Sorry, Emma, but guaranteed to make a profit. Look, there are some bumps along the way, and in South Australia we tend to climb and then plateau. Look, your point is absolutely on the money. It's simple. It's straightforward. Ask our colleagues on the other side of the table here what the AREIT stands for. I had to do a bit of research this morning. It'll be second nature to them, but to me it wasn't.
Okay, shares.
I think it's an easy thing to say that's easy here in Adelaide because property has had a history of not having, being extremely volatile here in Adelaide. But, the GFC was brought around by the American property market collapsing, and that brought many investors unstuck who just threw money at property because there was supposedly no risk there. So in investment, you always got to educate yourself. Don't fool yourself. You got to know what you're doing. As they say, a fool and their money are easily parted.
Strong words there. Hopefully that answers that for you, Megan. Now, Adam, I've noticed banks has just come through. Banks will lend against property to an overwhelming preference to shares. Who do you think? Why do you think this is? Good question, Adam. So you see that? So I've noticed that banks will lend against property in an overwhelming preference against shares. Why? Good answer.
I'll take the. Okay. There is a situation there where you would not recommend as much borrowing against shares as you would property because of the underlying longer term volatility. So banks are more comfortable lending against property, and that's true. They will only lend at a lower ratio against shares, and we would always take the approach that you're probably investing in smaller lumps in the share market than gearing yourself up with more risk into a property investment. But that means your overall level of risk is lower as well.
Fantastic. Well, now.
Oh, don't I get to say anything yet?
Oh, Emma, sorry.
No.
I was sitting very
It's a
quietly
real
in the
blokey
corner.
show here, isn't it? Come on, Emma.
Well, I was going to say that was a very well-scripted answer for Mark, but my reaction is banks don't like roller coasters.
Okay. So we better be fair about this.
Well, Mike raised a good point. You're not going to necessarily go to a bank and ask for, say, a $300,000 margin loan and then invest it in one share. You can go ahead and then we basically do what they do, but better through the use of property trusts. So, if you're looking for that diversification and if you're looking for those smaller segments that we're talking about, we can do just what they're doing, but probably more efficiently.
Well done. Thank you for the comment. Now we've got our IT guy that's down on his hands and knees trying to scroll so I can see the next question that's just come through. Mariah, what do you tell the first home investor are the most important factors when hunting for homes? So maybe a quick one from property.
Yes, use an REI member and location. Simple.
And could I say for you guys, sell your shares and get property?
Where you buy your first home, where you feel comfortable.
Right. And what about, let's just extend that question because I actually think it's a great question. And what about your first step into shares? How would you do it? What's a simple way to do it?
So it is a learning curve getting into the share market, and so it is important to pay a little bit of attention to the press, the financial press, and what's happening in the world. In terms of step slowly, get interested, start adding some shares to your portfolio slowly but surely, and it's amazing over time how investors who have been in the market for a long term, become wise and then start making better and better investment decisions over time. And the growth of old portfolios is just astounding what you can deliver over a longer term.
Thanks, Mark. Now we've got a whole lot more questions that are on the board there. We haven't got time to do them now. What we will do is get the gurus here to respond to those during the course of the next week. But for now, what I'd like to do is thank the experts for their help, and in the meantime you now need to vote. So those of you that are watching, you must vote because it's very important. This is This is really, it's the proper showdown. This is the real deal. Is it property or shares? And your vote counts. That's where the trophy goes. In the meantime, while we let you get on with your voting and just talk about it amongst yourselves back home and decide which one you're going to back, let's go behind the blinds and look at some property, and we'll be back for the results very soon.